Property tax is a complex and constantly changing subject. With property ownership widespread in the UK, tax issues can have a significant impact for many individuals, which means that effective tax planning is a serious challenge for anybody investing in property. The amount on which tax is charged is the net rental income for each tax year. Net income consists of the gross rent attributable to the tax year in question. If the property is jointly owned, the net income is then split in the relevant proportions and assessed separately on each individual, at the appropriate tax rate after taking into account any allowances or losses which may be due. For each tax year, half of the expected tax liability will normally be due on account on the 31st of January and the 31st of July, with any balance due payable the following 31st of January. The expected tax liability is based on the previous year's final liability. Landlords of fully, partly or unfurnished residential property can claim for the actual cost of replacing furnishings. This is not available to furnished holiday lets businesses. Replacement items that would be available for RFR include movable furniture or furnishings such as beds or suites, televisions, fridges and freezers, carpets and floor coverings, curtains, linen, crockery or cutlery. Fixtures that are part of the building and would not normally be removed if the owner sold the building would not qualify for the RFR. These fixtures would include bars, wash-hand basins, toilets, boilers, fitted kitchen units. Expenditure on repairs is allowable as a revenue expense for income tax purposes, provided that the work carried out does not represent an improvement. HMRC will normally accept that repairs do not constitute an improvement merely because more modern materials are used, such as when a single glazed window is replaced by a double glazed window. An example of an improvement would be work carried out on a roof, where instead of simply restoring the roof to its original condition, new windows were installed as part of a loft conversion. Expenditure in relation to improvement, additions or extensions to a property is capital and is added to the cost of the property for capital gains tax purposes. As a general rule, the replacement of part of an asset is a repair, but the replacement of an entire asset is likely to be capital. Interest on a mortgage or other loan incurred for the purposes of property letting is an allowable deduction for tax purposes. The loan need not be matched with a particular property, so if several properties are let, you do not need loans to be secured on all of them. Interest may sometimes be deductible on loans used for other purposes. In particular, interest on any loan up to the value of the property when it was first let will be allowable. If more than one property is let, a loss for a year on one property can be set against a profit on another. An overall loss cannot be set against income from other sources, such as employment or investment income, but must be carried forward against future profits from the property letting business. Any losses not utilised at the time when property letting ceases will normally remain unrelieved. For example, if a property is purchased as a private residence for £400,000 with a £200,000 mortgage, but is let out sometime later, when it is worth £500,000, an additional mortgage of up to £300,000 could be taken out, and interest on the full £500,000 would be allowable. A landlord may not take a deposit in respect of an assured short-hold tenancy unless it is covered by a tenancy deposit scheme. A tenancy deposit scheme is designed to safeguard tenants' deposits and facilitate the resolution of disputes arising in connection with such deposits. There are two different types of schemes, namely custodial schemes and insurance-based schemes. The landlord or agent must give the tenant details of how their deposit is protected within 14 days of receiving a deposit. Income arising from the letting of furnished accommodation, which is part of an individual's main residence, is exempt from tax. provided that the rent, before any deductions for expenses, does not exceed the limit set for the tax year in question. The property must in fact be used as a main residence at some point in the relevant period for the exemption to apply. For example, if an individual goes overseas on the 1st of December for 18 months and decides to let part or all of the house from that date for a year, rent-a-room relief will not be due for the following tax year, because the property was not in use as a main residence. Rent-a-room relief only applies to residential, not commercial letting. Capital gains tax, otherwise known as CGT, may be payable when a property which has been let is sold at a profit. CGT will be due where a sale takes place within 18 months of the date when the property was last used as the owner's private residence. Where a chargeable gain arises on a property which has been a private residence and was also let out at some point, a lettings exemption is available. Gains on properties within annual tax on enveloped dwellings, otherwise known as ATED, are liable to CGT, and gains realised by any non-residents on any other UK residential property are also liable to CGT. A property can be subject to both ATED, CGT, and non-resident CGT, and different calculations are required for each version of tax. The specialist property tax team at our firm can assist you with all landlord tax issues. To find out more about how we can help you, please contact us using the contact details shown on this screen.